Well, folks, happy Friday. We have a very special segment. I'm always excited when I talk to these two very intelligent guys here. We're finishing up a great business conference that we had this week. That's why we're casual. We talked about it last night. We're like, yeah, let's leave the suits aside. But I have Paul Meeks, ladies and gentlemen, and Peter Nielsen with Independent Solutions. Now, I'm blessed and happy to have them handle my clients' money, and they're very unique. They have their own way of doing things, and collectively they have about 200 years of experience. I thought today would be great for them to talk about the economy, the stock market. I know, guys, you don't have a crystal ball, that old saying, right? But, you know, I think this is very important and timely because if you look at the TV talking heads out there, the world's coming to an end. So some of the takeaways when you all had your roundtable was, and I want you to talk about it and address them. Number one, the economy is not as bad as they're saying, right? Paul, what do you think? I mean,
No, I agree. Obviously, as interest rates rise, there is some threat that that'll filter through, not immediately, but with a lag effect, and it'll start to slow down the economy. But as of now, if you were to ask me, I would say yes. We'll absorb that, and we will not go into a recession, at least in the next year or so.
Right, they're throwing recession around like candy. Well, it's going to happen. It's going to happen. Why? Because I have that gut feeling. Yeah. And Peter, you before we get going, I want to. These guys have more acronyms and letters attached to their names. You guys should be 85 years old with all your experience. I'm looking at this. So Paul loves rock and roll, by the way, folks. He's a Bruce Springsteen fan. AC/DC.
Big Springsteen fan, yeah.
Yes, and 32 years in the business. He ran the largest technology fund for, can I say Merrill Lynch?
Yeah.
Okay. Yeah. So he ran it for Merrill Lynch. You can catch him on CNBC. Hey, by the way, I got quoted on CNBC, so I'm part of the family now. I don't know. And Paul, even though he's known for tech, he has other portfolios, and of course, him and Peter go way back. But Paul is a college professor. He's an adjunct finance and accounting faculty member. I got to hold my breath when I read all your things here. He teaches at the College of Charleston, the Citadel, in Charleston, South Carolina, where they have good golf courses, right?
They do. I don't play much, but that's my understanding.
Yeah. So he does live there. He joined Independent Solutions 4 years ago, I would say.
Yeah.
And he's a chartered financial analyst. He has a dividend model because, Paul, what was it, around Thanksgiving of last year that you were kind of like, I don't like the way things are going. And you shifted some of the money into that portfolio. Now, Peter, who's a good friend of yours as well, and he's got 30 years experience. He's also a chartered financial analyst. You two have a momentum portfolio that you do. And Peter, you really study the markets. That's one of your fortes and niches, right? You pull out your crystal ball and you look at the financial status, and you have your Master's of Business Administration degree from Simon Fraser University. Again, I think I could keep my fans another 10 minutes to talk about all of your experiences. But I want to get right to it. So the first thing is, yes, how is the economy doing right now?
Okay, well, like Paul said, things are not as glum as maybe some would say, or maybe even as the market may portend, right? So typically markets do terrible in front of recessions, but the market, what's the old saying? The market has predicted 12 of the last 8 recessions or something. So the market can be rocky and with no economic underpinning. So one of the things I do object to is some of the economic forecasts we see. So I think it was Fannie Mae came out and predicted a recession for, 2023.
Okay.
So the economy is going to decline by 0.1%. 0.1%? The misses, that the economists have been so wrong that the forecast, like, I'm not trying to be demeaning to anybody, but honestly, the level of precision that implies doesn't exist. We will not know what 2023 looks like for a long time. Number one, this this economic cycle isn't like a traditional economic cycle. We've gone through government-mandated lockdowns that has stifled the economy, and now we're coming out of it. And obviously, there's a big mismatch between the growth in demand and what the supply chain can supply to meet that demand. Partly because of COVID in Europe, China, and so forth. So we've been stoking inflation as a consequence, and the Fed is trying to respond by tightening financial conditions. It will reduce demand to some degree. Like mortgage rates are now 5%. At the beginning
that's
of the year,
right.
There were roughly 3%.
Right.
So we should see demand drop down, but nobody is forecasting a recession. Well, in our shop, nobody's forecasting a recession.
Independent solutions.
Yeah.
Yes. Okay. So it sounds like these economists are like weather people. They keep their job by being wrong, and I don't understand. I mean, you've got to be pretty bold to make those kind of predictions without the data to back it up. Are they just? Is it a gut feeling that they have?
Well, everybody's got their econometric models and stuff, but the problem is this is not your standard economic cycle.
Right.
But like economists have been so wrong throughout the cycle. Like the what epitomizes better than anything is the monthly jobs report. The monthly jobs report, except for this last one, the last 6 or 8 or so, the economy's produced way more jobs than anybody's forecast. You know, where are these people coming from?
Well, it's really weird because unemployment is, 3.6% somewhere around there?
Yeah.
But you go to a restaurant or anywhere and they have signs. I'm sorry, please be patient. We can't find people that want to work.
Right.
Yeah.
So, Paul, you think with the COVID and everything, they just retired early? They said, you know what, screw it. Let me just take my money and I'm done. You think that's part of the reason that it's hard to find? I mean, Walmart is paying, I think you said that, Walmart is paying truck drivers $110,000 a year. So if you have an MBA and you're a junior partner at a firm, you don't start off at $110,000 a year.
No.
But at the same time, like I say, you go to a retail store, restaurants, and people, they have a shortage of it.
Yeah.
And I thought the opposite. I thought, well, low unemployment means there's not many people working, or So, do you think that's going to continue, this labor weirdness that we're having?
Yeah. So, in the question you said part. I do think it is a part of it, and so I do think it's a permanent part. Right? You have some people call it the Great Resignation, but yes, there's some dissatisfaction. Of course, we really muddied the waters during COVID, right? We went to a society where it's all remote work, school, and play. And so, yes, I think as Peter talked, we'll have some kind of comeback. Maybe it'll be halfway back, maybe be some portion thereof. But yes, I think some of it is permanent, the new reality, and some of it's transitory. But it's a mix.
And they're trying to increase wages, which is not going to be great for small mid businesses to stay afloat.
Companies like Starbucks, right now Starbucks is having a flood of baristas that want to unionize, and Starbucks was a company until a year or so ago that was known to be really pro-employee.
Okay.
And then you have the same thing at Amazon, an absolute rebellion to unionize some of their warehouses and distribution sites. And so, yeah, there are some things going on that are quite unique.
Yeah.
The biggest thing is this ugly head called inflation, huh? Isn't it funny how I think you joked about it? Because people think presidents set policy and they affect markets when it's really Chairman Powell. And he was playing it off saying, this is transitory, right? And when did he change his mind? After he got elected?
Yeah.
Wait, I'm only kidding. It's not transitory.
Yeah.
I mean, some people are saying it's 7-8%. I mean, where do you think real inflation is?
So inflation is probably the most personal number you will find. So there's the national inflation rate, which is 8.5%.
Okay.
But if you go to the, I think it's Bureau of Labor Statistics, if you go to their website, they'll have, inflation rate for the South, inflation rate for New York City, and like they'll break it out by some regions. And so if you're living in Atlanta, your inflation rate's 10%.
Okay.
If you're living in New York City, it's 6 or 5 or something. I can't remember the particulars.
Okay.
But it's lower in New York City than it is in Texas and the South. And probably the driver of that is people drive longer distances in those places.
Okay.
So if you got a long commute, your personal inflation rate is much higher than my inflation rate because I work from home. So yeah, inflation really is probably the most personal economic data point there is.
But it's weird because they say 8%, but I go to the grocery store and I'm paying 30% more for goods. Used cars, I could sell my vehicle that I've paid, it's been paid for 3 years for maybe $1,000 or $2,000 less than what I bought it for.
Yeah.
So there are some components, and you mentioned the not just used but new cars that are really skewing the overall number. So Peter's absolutely right. You take a look at the components; it's regional, and then it's by different drivers of inflation, and some of it's screwy, and then there's also some of the stats are calculated differently today than they were back in the 70s and 80s, which is typically the compare. Oh, we're back to Jimmy Carter and the 20% interest rates.
Reagan times, right.
But you can't really do an apples to apples because they computed some of these components differently back then than they do today.
Yeah. So what to think about it is CPI is a value. So they have a basket of goods that goods and services you're gonna purchase, and they're going to compare they're going to change the basket over time because consumption patterns change. Like in the 70s, we were buying laptops or iPhones or what have you, right? Yeah. So they change the makeup of the basket over time, and then you make a comparison. Some people will say, "Hey, look, that's just not very fair. Inflation rate is really 20% or something." No, the guys at these government economists, they are doing serious work and they do it well. So
it's really an overplayed narrative because it's around 7-8%, but there are always going to be some exceptions that are higher. Now, here's the other thing that people fail to realize. This has already been priced in the market, right? Mm-hmm. They've been talking about multiple rate hikes, and how many have actually transpired? One, right?
Right.
Yeah.
So even if the Fed raises it by 50 basis points or more, do you see a market sell-off?
If it is the consensus, there shouldn't be really that much of a movement because it's already buried in the stock prices. And the other thing, whether it's interest rates or inflation, you don't necessarily have to see, particularly for inflation, for it to drop off significantly. You just need to see it peak and then start to decelerate. Mm-hmm. So Peter's absolutely right. Last month, 8.5%. What happens if next month it's 8.1? People say, wow, it's an improvement.
It's an improvement,
So
right.
It doesn't have to go back to 2% where it was before all this mess. We just need to see a deceleration. And I think if we see even a slight deceleration, what I call like less bad, then we could have a really nice rally in the markets.
Yeah.
Yeah, that's the thing. That's the tricky part. When is it actually going to peak, or is it going to keep climbing?
Well, I don't know.
Nobody really can.
Well, I think on the inflation number, we're fairly close. Can't pinpoint it, but I think we're fairly close to the peak.
You don't see it going to officially 9 or 10%.
I don't think so. My view.
Okay.
Yeah.
So if the Fed does raise it, it's already factored in. Another interesting thing, and you all discussed this yesterday, bonds and treasuries are still not attractive enough. And hasn't that also kept the market going up? Because what are people going to invest in?
Yeah.
They're not going to go to cash, right?
Yeah. So fixed income as an asset class. It's tricky. So everybody's got a view on what they call the market neutral rate of interest.
Okay.
So I teach at Anderson University. So what I teach my students is the official line in interest rates. That there's this market neutral rate of interest. On top of it, you add an inflation premium. On top of that, you add a maturity risk premium. That is your nominal yield. Well, research from the New York Fed suggests that term premium is basically flat, and the way markets work, it's very rare that it's only about 1 in 4 years where you're actually at that ideal rate of interest. So the markets can be lower. Yields can be lower for a lot longer than a lot of pundits say. So, some people will.
That's my point. It's probably going to be a while before bond rates and corporate bonds and the treasuries are going to be attractive, correct? Because if you're getting 2.7% or, somewhere thereabouts on your money with inflation and taxation, you're operating at a negative space, are you not?
Well, the way I look at it is, so typically when they talk about rates, they quite often quote the yield on the U.S. 10-year Treasury.
Okay.
Some people even call that America's risk-free rate. So right now it's in the high twos, as you just mentioned. If you get some stability or less bad news or a slight deceleration in inflation and the yield on that instrument is over 3%, I think we actually get fairly close to turning the toggle switch to where bonds become more attractive than they've been in a long, long time. If we can go above 3, I might be interested in taking some money out of equities and putting it in bonds.
What about corporate bonds? You're speaking just about the treasuries right now.
Yeah, so with corporate bonds, you're adding a credit spread. The risk that the company goes bankrupt or insolvent or what have you. So you're making more on a corporate bond in general than you are. But one of the things we're seeing is the spreads on investment-grade corporates are very, very tight. We think that there is opportunity in the high-yield space because in high yield, about 20% of the high-yield market is actually these junior energy companies who have repaired their balance sheets as much as they can.
And when you say high yield, what kind of rates are you talking about?
Oh, gosh. I think the spread on triple Cs, which is real high yield.
Dicey. We call that dicey.
Wait a minute. They make triple Cs? I thought they drew the line at triple B.
Yeah. So if you're looking at S&P credit ratings, they go from triple A, double A, single A, triple B. Below triple B ratings, that is non-investment grade or junk.
It's okay. So we're getting into the Milken rating system, right?
Exactly. Yeah.
Okay.
But here you have an environment where 20% of the high yield market is energy companies, and they've repaired their balance sheets by and large, and of course oil prices are through the roof.
Right.
This is like their golden age.
So that's a good point, and I want to ask you. I'm not going to ask you to pick your favorite stocks. I hate that. Hey, what's your favorite? But there are some sectors that, through this inflationary market and the way the economy is, that people should do well with. And what do you think they are? I think you mentioned utilities, financial services. Tell the audience what sectors you think will be in good play for the next, 1 to 2 to 3 years.
Boy, I'm going to steal a page out of your book. I'm actually going to say tech is probably a good place to be.
Oh, boy.
So,
he's trying to steal your thunder, my friend. Are you trying to flip the switch?
Yeah.
You better not have an investment horizon of tomorrow, though.
No. Look. This is if you're investing in stocks, you have a long-term investment horizon, right? So,
but people have a different perception of what long-term is.
Yes.
And that's what I try to emphasize with tech, because they always tell you, oh, yeah, I'm long-term oriented. And if the stock takes a spill tomorrow, they'll call you.
Yeah.
Long-term meaning 5 to 10-year outlook, correct?
Yeah. I think the outlook for tech, if you really do have, you don't even need 10. If you even have a couple-year perspective, which I think is proper, you can do extraordinarily well with a couple of these names that have been decimated in the last. Essentially, the tech correction started the week before Thanksgiving. So
they've already made their
Putin.
Yeah, Putin. Let's talk about that raving lunatic as well. How that's thrown into the mix. But since Thanksgiving, how far down has the tech sector been, Paul? Because I know that you started moving your money out of that back then. So in the last quarter, what?
So we've been in a bear market or the verge of a bear market, but within that, beyond the FANGs, beyond the large cap names that dominate the NASDAQ 100, there are some more speculative companies that in that horizon have been down 60, 70, 80%. And these are mostly these companies that don't make money. but they got people excited during COVID, like a Peloton, right, with all their new subscribers and bikes sold. But those kind of companies where they don't have the earnings and the cash flow, and they've been driven up by this COVID driver, and then when that is taken away, those are the ones that have been crushed because they don't really have a plan B.
60%. Geesh, I guess if you're going to own it for the next 5 years, it's on sale.
Yeah. So there are some that are way down, Denny, way down.
I think the problem is most people have lost their sense of reality because we've had arguably the biggest bull market for so many years. Look what happened in COVID in 2020. It got corrected. It went, 30%, and a few weeks later, it snapped back. So people are now like, oh, yeah, that's going to happen again. If we have a correction, I'm going to do nothing, and it's going to come back. Where you two have both been rebalancing. Yeah. You're still bullish. You're not bearish. But you're
I had been heavy cash and in the bunker with the dividend portfolio vis-a-vis the tech portfolio, but now I'm starting to put recent weeks money back to work.
I think you also said that you were surprised that European stocks have not performed well in the last 6 months. When I think 6 months ago you thought they were a good play,
they
right?
were, yeah. As a matter
what
of fact,
changed?
Well, Putin.
Yeah, Putin. Yeah.
So when the year got started, European and international stocks were actually outperforming U.S. stocks, and then Putin invaded Ukraine, and that changed. It seemed like the closer you were to the conflict, the worse your stock did. And the example I gave at the conference was of Deutsche Post. So this is a German postal system. The company was established in 1490. So they got the parcel and post system. That's about 20% of their business. 80% is DHL. So they run the world's third largest logistics network. FedEx is a great comparison. So FedEx, their return on equity is just a measure of profitability over their cost of equity is double that of FedEx, and it's trending higher. And the stock has typically followed that up. FedEx flatlining. And here we have Putin invading Russia, and the stock sells off twice that of FedEx. So yeah, Deutsche Post, in my opinion, great value.
I think he's picking. I
think he's answering your question.
And I didn't even answer him. Hey, what's your best stock pick?
Yeah, I had that on his notes to talk about whether you asked it or not.
Listen, every time you mention Micron, it ticks up. Right? Dan even bought. He asked you after he bought some more Micron.
I hope we don't go to jail.
You're still right inside of
the Crowbar Hotel.
I mean, semiconductors. I mean. You told me 6 months ago that there was such a shortage of the problem with automobiles is they couldn't get the parts to push it out there. The chips, right? So that caused the prices to spike up on used vehicles because people couldn't buy. But that's flattened out, right? Autos have gotten less volatile in the pricing for the new vehicles.
Denso is also in the international portfolio. They reported yesterday, and they beat on earnings substantially. Earnings were up 120% on, I think, 20% revenue growth. And so revenue growth beat estimates, and their guidance for future revenue growth was ahead of estimates.
Okay.
So yes, it seems like the supply chain it's not fully repaired.
Yeah.
But things are better than analysts had.
And that'll be a pretty good. You were asking about the economy, Denny. That'll be a pretty good tell, right? We're playing poker. We're looking for tells. When you start to see Ford and GM and their brethren come back and say, "Oh, we're now been able to get some semiconductors and other components so we can actually build these cars." Because that's a perfect example of how semiconductors over time have just proliferated, everything in the industrial space. It used to be in the old days the only thing you followed in the semiconductor industry was PC sales. Now, semiconductors are everywhere, including all around here.
Phones. I mean,
in your fridge,
in my refrigerator, right?
So that'll be interesting. But I follow semiconductors closely. We're seeing some improvement on the margin, but I expect that part, at least, of the supply chain to be clogged for some time, well into next year, unfortunately.
And next year is when some are guessing that we could hit a recession. But what was GDP for last year?
Oh gosh, was it 5.4%?
It's 5 or 6, yeah.
Yeah,
Historically, that's amazing.
yeah,
Five
but it's a comparative number, right?
compared to the year before.
Exactly.
Yeah,
Yeah.
it's always
And it will not be that high this year,
yeah.
but it won't be. Recession means it's negative down.
yeah.
Which you find it really hard to believe that will, at least for this year.
Yeah, so there's the Institute of Supply Management. They survey major U.S. corporations on their manufacturing intents. They figure the guy that's got his trigger on the manufacturing supply has the best idea of what's happening. So you do that enough over a big enough sample, you got an idea of whether the economy is expanding or contracting. So they have this thing called the ISM Purchasing Managers Index, and the dividing line between expansion and contraction is 50. So anything above 50 is expansion. Anything below is contraction. The higher above 50, the more robust the growth, right? So we were in the 60s, which is very, very high for that data series.
You two did say growth is not what it used to be 5 to 10 years ago.
But now the ISM has declined into the 50s, but it's still 57. So the trend is towards slower economic growth,
Okay.
but it's still fairly robust. That's what the data is telling us.
Well, again, I think, Paul, you thought on the radio show and some of the shows we did, you did see high single-digit returns on equities last year. It happened. So maybe this year we could be down because that Ukraine situation, if it doesn't resolve itself.
And we've dug a very big hole, and when you're in the hole, you have to have monster returns just to get back to even.
Yeah, that's the problem,
So
isn't
it may be tough to have a positive return for the full year, but I would still expect some kind of nice rally in the second half.
What do you think would propel the rally? That the rates have been normalized, inflation's in check? What do you think could spark a possible rally?
So the rates forecast, the Fed has been pretty transparent. They're going to be raising rates at least to some amplitude at every meeting well into 2023. So that's out there.
Okay.
So what I look for is what I said before, the peak inflation number, because at the end of the day is the backbone that drives the other stuff. And if we see peak inflation, I'm not going to worry if that inflation goes from 8.5 back down to 2, because that will take forever. But if we start to see a couple of sequential months, which means in a row, of improvement of a lesser growth rate, then that's my catalyst.
Yeah.
Now, hence, you two have a momentum portfolio, which is that a contrarian play in the market?
No,
Can you
not
describe what it is that the momentum portfolio does for investors?
Yeah, it's a quant portfolio. So it basically takes asset classes and it calculates takes the current price, measures it relative to the average price over the prior 10 months.
Okay.
And if it's higher, it qualifies for inclusion. If it's lower, it's thought that the asset class is trending lower. So
it's trend following rather than contrarian. It's
Yes.
trend following.
Okay.
Yeah.
And they're minor adjustments. It's kind of like you don't take the whole aspirin bottle. You take one aspirin in your adjustments, correct?
Well-
I think you showed me where you did like a 1% adjustment on a monthly or quarterly basis.
Well, it has to exceed the 10-month moving average by more than 1%. So,
Okay.
So we have had some periods where it's done like wholesale changes, where it's sold
Okay.
out of everything and gone to cash. And so the advantage of it is it doesn't matter what Paul's opinion is or my opinion or anybody's opinion. This is all driven by market prices. So right now, the model is in U.S. value, commodities, gold, 44% cash. So it's
44, because you're waiting for deals that come up, right?
We're waiting for market signals to say, yes, it's safe to invest in real estate, it's safe to invest in international stocks and whatnot. We're just not getting those signals in that model right now. I would say, though, for those stock investors that are in our other models, right now, stocks are selling for less than intrinsic value, at least our estimates of intrinsic value.
You did say that based on last year, even though we've had some sell-off, that now they're more valuable, to coin a phrase. They're on sale.
They're on sale.
They're on sale. So now it's a question of, well, when do I, stick my toe in the water and just buy a little bit of it and see what happens? Is that
if you want a cheap stock, now's a good time to buy.
okay? Well, that makes sense. So once again, the sectors that should do well, no matter what, are the utilities, right? Oil's still going to do well, probably, right? Because my God, do you remember when Exxon sold off and was around $30 a share?
Yeah.
What is it now?
Oh gosh, I couldn't cite you the number. But the interesting thing about oil, and Paul and I have it in that dividend portfolio.
Okay.
We've got a few energy names there, but the interesting thing is, so what oil can be a head fake. So prices spike. So there's a futures curve. So there's a front month futures contract. That's what we see as the price of oil. And then there's like 3 months out and so forth. And so the futures curve tends to slope upward. And, because if you're selling the oil and you're only going to deliver it in a year, I don't want your oil right now delivered to me in a year. You have to custody, you have to store that oil somewhere, and there's a cost to you. So
Right.
It's usually upward sloping. But in uncertain times, that relationship flips. So the curve is actually downward sloping, or in backwardation, as they call it in the industry. And because I'd rather have the oil now, so I'll pay a premium to get it now. Well, in past times, what's happened is people have plowed into energy stocks, and only to see the curve flip. So if the price of oil is at $60 a year from now, well, that futures price is maybe not a bad indicator. So they see oil, they buy the stock when the oil's at 120, only see the price of oil crash along with the stock price. Now, what we're seeing now, though, is we did see that relationship earlier in March. There was about $20 difference between the front month contract and 3 months out. Now it's like $3. Yeah. So that futures curve is really flattened out. So the risk in buying into energy stocks has really come down a lot, in my opinion.
Again, they're attractive now.
And another thing that's interesting that came up in the conference yesterday is there is no question that they're on a flyer right now, and part of it is based on what's going on in the Ukraine. But there's 11 sectors that make up the S&P 500 or make up the economy, energy being one sector. And yes, energy has been the best performer this year, but for many years prior to this year, it was among the worst. And so it's not that these stocks were reasonably priced and then they got too expensive. Yes, they've had a big run, but they were in the dumper for so long that they're still not necessarily overvalued.
Yeah.
And so that's why you stick in them. You say, wow, are you guys getting in the ninth inning? No, we actually think there's more upside.
Exactly.
Yeah.
Well, you started this dividend model, which is great, because you typically buy companies that are already yielding 3%, but have maybe a 5 to 8% upside, right?
I'd hope so. Yeah.
So for those who don't want to, until tech comes roaring back,
or bonds become more attractive,
become more attractive, it's hard to find yield.
Very hard.
So investors should do that. And folks, not all money managers are equal. Independent solutions, they're actually buying positions. I don't want to bash anybody, but there are some companies, for lack of other words, that are actually buying funds and putting a wrap fee on it. We're talking about individual equity positions. And that is a difference, because you cannot change a mutual fund or an ETF if the market...
Nor could you ever talk to the portfolio manager if you wanted to.
Exactly right. So, folks, for my clients, wouldn't it be nice to actually speak to the portfolio manager to come with a custom portfolio for you? You just can't get that. And sometimes bigger is not necessarily better. Not that you guys are small. You have a lot of great experience. You talk on the phone with clients. You're just not going to get that. And it's not just about performance. It's about customization and having access, understanding what clients want. And let's face it, I'm sure you two have never lost business because someone totally outperformed you or wasn't even close.
Yeah,
that's just not the business you're in.
Yeah, there's definitely a service component. So when somebody brings us a portfolio, a taxable portfolio in particular, you know, we're sensitive to the gains that are in there, and we'll work around trying to create we'll customize our portfolio for their situation.
And then the private wealth group, with the minimum there is $1 million, right? Now you can offer private deals where you can find some nice yielding bonds for a company, and talk about that. What you're doing in a private wealth group that's different than the normal independent solution account.
Sure. So the nice thing about our firm is, even though we're not a big wirehouse, when I say wirehouse, I'm talking about the Wall Street Goliaths, right?
Exactly right.
We do have a full suite of products, including the opportunity, which we probably would recommend keep it a pretty skinny slice of your asset allocation pie, but to do some of those deals. But again, as an alternative asset, it should be, unless you're the most aggressive investor, it should be a pretty small piece, but it's available to us.
I don't find too many aggressive people minded these days. I think a lot of them are looking for safety. They still need to make money, because we talked about inflation. You need more than 2.7 or 3% on your money to sustain a successful retirement or a future retirement. So people are looking for safer alternatives. You said you were at 44% cash.
Well, that's the model's dictating that. That's not me.
Okay, yeah. So until things change in the market where you feel, you know what, I like this equity right now. I'm going to allocate more into it.
Yeah. So just to be clear, this is based on a paper that was published in a academic journal. Okay. So we just basically follow the recipe. And it's got a great history of performance dating back to the 1970s. So we're taking something that's got a good track record and replicating it. So far, it's going great. But for anybody that's trying to time the market, that's pretty tough to do.
Timing doesn't work. However, they should really consider rebalancing for the unknown that may happen. Talk about, in your opinion, what could really hurt us going forward? Let's say the next. We don't have crystal balls, that whole stupid saying that we all use. But let's say going into the summer and fall, into next year, what could affect the market where investors should be, looking for?
Well, okay, so there's two big unknowns. You can't quantify them. One is COVID, because we've gone from
COVID. What's that? What's he talking about? Well, it's not safe.
Well, the Delta strain was something like 4 times more infectious than the prior strain, and now we're onto this B2 strain, which is supposed to be something like 10 times more infectious than Delta, and so forth. And there's all these subvariants.
If the lockdowns happen again, that's going to affect things, you're saying.
Well, see, it's affecting things already, because they've had all these massive lockdowns in China. These are Shenzhen and Guangzhou and all these major cities. These are cities that are, 5-10 times larger than New York City. And
is it true they locked down like 20 million people in the one city and they only had, I think, 50 cases? But it was that.
I read a story the other day, not a story because I read it, it's factual. I forgot the name of the town. But it wasn't, Shanghai, which I think is well over 20 million people. It was a city of several million people, 2 to 3 million. And they had 2 cases.
And they shut down the whole city.
Wow.
Oh boy! Yeah, well,
that's what they call the zero COVID policy. Dude, that is zero COVID right there.
So look, if that happens, that's going to affect obviously the market, because it'll get people to stay at home, not spend money, maybe not even go to work.
And as Peter said before, it impacts the supply chain, which impacts U.S. companies and U.S. consumers, because a lot of that supply chain emanates in China.
Yeah, and prior to COVID, where was growth coming from? Ford and GM and so forth? That was China. And the other thing I think that's an unknown is Putin's war in Ukraine. I have no idea what's going on there. Apparently, Putin is reportedly in ill health.
People might be spiking his drink right about now, because I don't think. You know what's so interesting, guys? And again, I'm just a layman compared to you. But this market has kept, even though we had a sell-off, when you look at the war, the supply chain issues, COVID, the list goes on and on, aren't you a little bit surprised that it's fairly been stable with all the things that have been going on in just the last 6 to 12 months?
Well, I think part of it tells you how irrelevant Russia has become, aside from its military.
Okay.
Way back in the 90s, when,
the USSR.
Yeah,
Is that a Beatles song?
Let me think. But they used to talk about, how do we invest in emerging markets? Well, there's the BRICS, Brazil, Russia, India, China. Nobody talks about Russia anymore in terms of emerging market investments. They really got left behind.
Is their economy that bad?
Well, I mean, that's part of the problem, right?
Yeah.
When you're doing a crappy job of running your economy, what's Plan B? Well, so sometimes these dictators, they look to, foreign conquest as a way to try to, rally people around the flag and grow their wealth if they're successful. And so far, Putin hasn't been very successful.
And so many companies have pulled out, multinationals that had actually reasonable operations in Russia. And even if Putin stops with the Ukraine and doesn't go on to, reassembling the Soviet Union, I don't think these companies are coming back. So he's really putting a massive dent, not just today, but in the future with these economies, because they're not going to turn around and say, "Oh yeah, we're coming back."
Right. He's really making them irrelevant.
So a irrelevant economy becomes even more so.
Yeah. I understand that they were threatening to take over the McDonald's locations there.
So yes, COVID, that's a big factor. This war, I'm always fearful that because he's so unpredictable.
Yeah.
That we get involved because he does something to a NATO country,
right?
Then we have to step in. And let me tell you guys, if that happens,
that's bad.
People are going to be running for cover.
And my issue is, and it's related to Peter's, because if Peter talks about COVID and the supply chain clog causes the inflation. My biggest worry is actually not that. My biggest worry is I'm wrong about this inflation peaking. What happens if I'm wrong and 8.5
and it keeps going,
8.5% goes to 8.9, goes to 9.2, then the Meeks thesis is wrong. I'm hoping not.
Well, I think
so. If you're wrong, should I call Joe Kernan to tell him that he can get you again?
Yes,
because he loves to bust your stone on CNBC.
He does.
Well, okay. So when is the next time that they're going to talk about that, where we can see whether we're going in the wrong direction? When's the next time they report inflation?
Oh, I think so we get the non-farm payrolls report next week.
Okay.
The Fed reports next week. That's a big to do. But we also got non-farm payrolls. It's either a week following non-farm payrolls or the week after that.
Okay.
So roughly the middle of May.
And there are two numbers. Peter earlier mentioned the CPI, which is the Consumer Price Index. That's you and me.
Okay.
But there's also the PPI, Producer Price Index. Think of that as wholesale price inflation, or businesses buying businesses. Like business A has to buy supplies from business B. So there's actually two numbers that are reported that I look at. The CPI is the one that most people talk about. There's also the PPI. So there are two numbers, and they both are released monthly.
Yeah. There is some good news on that front, right? So, inflation.
Yeah, let's talk about, we got the gloom out of the way. Let's talk about, hey, if the following things happen, Paul thinks we could have a rally, maybe by what, the last quarter or so?
Yeah.
Yeah. And so what needs to happen for that, to transpire, that we have a rally, people get more confidence and they're stepping in and buying more?
Well, I was going to say on inflation, the bond market actually has an inflation indicator. So we issue Treasury bonds, and we also issue Treasury inflation protected securities, or TIPS. Mm-hmm. And TIPS are real returns, and bonds are nominal returns. So if you net the yields between the two, you get the market's estimate of what inflation is. And if you look at 5-year and 10-year TIPS break-evens, or the implied inflation rate, they're trending lower. So I think the 5-year TIPS is around 3% versus our 8.5%. So that means the market is saying that over the next 5 years, inflation is going to average 3%. So that is
I'd like to see 3% inflation.
He's dancing in the streets.
Well, look, they can't print any more money.
Yeah.
Well, actually, they can, but
that's part of the problem.
I stand corrected.
Yeah.
Yes. You really think they would try and print some more money? I mean, is that throwing like fuel into the fire to see what happens?
Yeah.
What?
well,
I want to see
the Fed is part of their support program during COVID is not only did they lower interest rates, that's obvious, but they also bought bonds, and so the Fed, which is our central bank, actually increased the size of the balance sheet from about $4 trillion to $9 trillion. And as they raise rates, they're also going to let these bonds roll off. And so that's also another, what we call tightening of monetary policy. So yes, the big $9 trillion balance sheet hopefully heads back to the $4 trillion as it was before the crisis.
They throw trillions like it's nothing. If you go back a trillion seconds, you're not in the times of Jesus Christ. You're at 30,000 BC. And they throw trillions around like it's, nickels and dimes in our pocket.
Yeah. So that's one thing that makes this tightening cycle, the Fed tightening cycle, unique. They're gonna both raise interest rates and they're going to reduce their balance sheet. So as Paul said, there's two ways they can do that. When a bond comes to maturity on the Fed's balance sheet, it disappears, and the Fed's balance sheet lowers. So that's called rolling off.
Yeah.
So
they're just not reinvesting it.
They'll let assets roll off and the balance sheet decline. The other thing they're going to do is they're going to actually go out and actually sell assets into the market. We've had one example in recent history where the Fed has let its balance sheet decline, had basically no impact on interest rates, and that was in 2018, 2019. So they let the balance sheet shrink by $750 billion. So I know we're talking trillions. $750 billion, still a lot of money.
Still a hunk of change.
Yeah, I'd say you could buy a few condos with that kind of money.
Unless you're Elon Musk, and then it's nothing to him.
Yes.
Hey, they say that he lives at a friend's house. This guy, he just bought Twitter, and he doesn't have a house, apparently. Now, here's another factor, too. Perception is everything, isn't it, guys? So they're all watching, hey, what's going to happen in November politically?
Yeah.
Now, how much legislation have they really passed in the last year? I know they stopped, Joe Manchin stopped that big bill, which actually, if that would have passed, we might be seeing inflation at like 12, 14%.
Yeah.
So any thoughts if, I don't know, what if the Republicans take the majority? You think that's going to affect the market, or at least the perception of the market?
Well, I thought that the greatest risk is, regardless of your political bent, is when Biden came in. Remember, they thought at the top of his agenda was the tax increase.
Yes.
Right, to go at least halfway back from where Trump had lowered the taxes. But, of course, other stuff came up on the agenda that was postponed. And now if the Republicans take control of the House of Representatives and the Senate, that is pushed back even further. And so that's probably a good thing.
Absolutely.
Right?
Corporate tax rates will stay where they are. The current tax rates will stay where they are. That's my whole point. However, folks, I don't get political because it doesn't interest me that much. But, if the Democrats win, which they're not looking like that's going to happen, in November, if they get the majority, it makes you wonder, well, what are they going to pass? Like you say, they didn't pass the tax bill. I know that
I just don't think there's an appetite for it right now. So I think it's a risk that's been removed, almost regardless of what happens. At least removed for a while.
It almost sounds like it'll be a neutral zone because people are probably still afraid of jawboning certain things in the economy, which will make people upset.
Yeah.
And then the rhetoric will just be ramped up to the ceilings. I know that they say, that's why I like talking to Paul and you. Oh, Biden closed the pipeline. That's why gas is where it is. And Paul's like, no, that's not why gas is the way it is. There are other factors. However, perception from the consumers is that. I think their perception as well, if Republicans come in, they'll keep tax rates where they are, prosperity, happy days are here again. Where
I wish it was that easy, dude.
Exactly, right. You and I talk about this, and I'm giving you the perspective from the clients that I speak to, and that's what they're thinking. So, all in all, we're not in as bad a shape as people may think.
Well, so it's, Paul brings up a good point. It's worth noting that in front of midterms, traditionally, equity markets can be soft. So it's not so it's unusual times with the war in Ukraine and COVID and everything else, but aside from that, in midterm election years, political uncertainty tends to breed soft markets.
Yeah.
So, maybe.
And it isn't surprising for the party that's out of office, out of the White House, to have gains. And of course, Biden has a pretty low approval rating, so I would be surprised if the Republicans didn't come back in and win both chambers. I'd be surprised.
Right. And let me tell you, I don't know why anybody would want that job.
Yeah.
Some people have a theory. Well, you start off making a couple $100,000 a year, and then you buy a house in Martha's Vineyard. That's why they do it. No, I didn't say that. So this is great. I hope, folks, I'm a bad marketer. If you'd like to know more, please call my office, 561-537-5897, 561-537-5897. You know what's so interesting? You two have been pretty spot on. We've been we had the radio show, and it seems like every quarter or every couple of months we reconvene. And what I like about your approach is you don't make stupid, bold predictions. You're not trying to make the headlines. And you safeguard money more than I see certain fund managers that tend to be frivolous, or let's say more aggressive than they should be. You're taking the last 6 months to you still believe in equities. Mm-hmm. Bonds are not attractive. However, you are proceeding cautiously, as well as investors should do that, because we just don't know. And I think when that sell-off happened with COVID and it bounced back, they said, oh, well, that's reality. It's always going to happen. If we do have a sell-off, it's probably going to take more than a few months to come back, right?
Yeah. I mean, look, the markets are mercurial. I don't know. But, yeah, I'm with Paul. I don't think the markets are going to come back within the next 6 months or so. But, for people that have a long-term investment program, the idea is to buy low, sell high. This is your opportunity to buy low.
Yeah. And then the other thing that's important to know is no matter how savvy you are, you're never going to pinpoint time it, right?
Right. It never happens.
And Peter had a great slide yesterday in his presentation that sometimes bull markets, when stocks go up, can last a long time, and they can have over the years tremendous percentage increase. The problem is if you're in the bunker too long and you miss even a little bit of a couple of trading days in that huge cycle, you're going to miss a lot of the return. So at some point you have to have a long-term perspective, and you do have to get back in the market because you don't want to miss that recovery, man. Because the recovery can be pretty powerful, and it can be really truncated in a very brief period of time.
Yeah, Warren Buffett is not a day trader, right, guys?
No, he isn't.
The buy and hold. Look, if you like a company for the next 5 to 10 years, why should you emotionally try and time it and make decisions along the way?
Yeah.
You try to do the best, particularly in my world, tech. I try to be a little bit more cagey because I don't want to be the guy that buys something before it goes down 30, because in tech, something can go down 30% tomorrow. But still, at some point, you got to...
How jacked up would you be if tech starts making a run in, let's say, the last quarter of this year?
Oh, I think it's feasible. But yeah, I would be jacked up.
You would be, wouldn't you?
I would. I like being popular rather than hated. Like anybody.
But Paul, when you're on you're talking about your dividend model, and I know that's what you're known for.
Well, I like to have a plan B because I managed a lot of tech money. Yeah. The internet bubble popped.
Okay.
And I still have the lashes on my back from that experience. And so, I've always said, yes, I got to have later in my career.
Yeah, you were more
wherever I go, whatever I do for a living, if I'm still in the business, I got to have a plan B. And I work with Peter closely on the plan B.
Well, there you have it, folks. We're going to reconvene. Again, the office line is 561-537-5897. We need to have a road show in Florida, okay? I know you're in South Carolina, but
nice.
You like the office, right?
I'd be happy to do that.
Let's do some music, some entertainment. Let people know that they could have independent solutions. You guys are really a dialed-in machine. And one last thing that I forgot to say, because I think it's funny. You have rock stars on your team, all right? You never disagree on market forecasts with each other when you have your meetings, do you?
I mean, kind of all the time. But
you guys are probably the closest tied to the hip in your philosophy of the... But, you have David Mariaca, who's been stuck, but you have Dan Neiman, who's also famous, running the Neiman Fund, and you have John Thurr, who he doesn't look it, but John's older than all of us, man. He's in best shape that I've ever seen him in his life, and he ran the largest fixed income portfolio. So when you all get together, I just want to chuckle that you have to disagree in some things, right?
Sure.
Oh,
Yeah.
of course.
Makes it interesting. So, folks, thanks for listening in. Make it a great weekend. Make it a great day. And you know what? If you have your health, your sanity, and a good family, count your blessings and turn off the TV. Stop watching so much news. We'll see you on the next time on the Denny Artache Show. Thanks, guys. Really appreciate it.
Thank you.
Thank you, Denny.